Hello value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Dropbox, the cloud collaboration platform. So we've got a lot to discuss here. So ultimately we're talking about a company that isn't that attractive. There's a lot of kind of reasons for investors to shun this potential opportunity. But as we dig in and we see that actually once we peel back the overarching thesis that everyone is looking at and we kind of dig in a little bit further, there's a lot here to actually be attracted towards this investment. So on the surface, this is one thing that's immediately struck out to me. So if you look at Dropbox, it's actually growing at a double-digit revenue growth rate. And they actually increased their guidance from 11% year over year for 21 to 12%. Doesn't seem like a big driver, but as you'll see, there's actually more here than meets the eye. So the next thing that I wanted to highlight is that for me as an investor, I want to see that the business is healthy, and I want to see that the number of users using the operation or using the company is growing. So you can see that for since Q2 of last year, the number of users growing is up 8% year over year, and it's reached 16 million. Okay, so this is the sequential graph, so from Q1 to Q2, but year over year it's up by 8%. So the number of users adopting Dropbox is actually increasing, and this is important because you want to see that the company is able to grow out the number of users rather than just relying on pricing power. So that is one thing that I look for, and that's obviously here represented. The other thing is that even if we push aside its ability to grow its number of users, the number of its pricing power is also up 5% year over year. So average prices are up 5% year over year. So you can see here in the graph, in the illustration, that land and expand strategy is clearly working. As number of users coming up, it increases the virality of the underlying platform, as users need to share or create content and put it in one space, and then being able to use either, for example, HelloSign to digitally sign that, or just to be able to get other companies or other users to really look into the data and look into the content that's created. So that's something that's really, really important. And as more and more users become either freelance workers or creative users in general, you want to be able to share that content. And this is something that Dropbox, it's not the fastest growing company in this space, but it is really taking along more than investors may think about. Now, the other thing that I wanted to highlight is that they've guided for this year for their free cash flow to be at 720 million at the midpoint. So not only is that an improvement from where it was guiding before, so halfway through the year, they've gone from guiding for approximately 680 million of free cash flow to 720. So there's a 440 million increase halfway through the year to the amount of free cash flow that they're making. Now, their balance sheet is actually holds some convertible notes, 1.4 billion, but that can be netted out by the 1.9 billion of cash and equivalents it has on its balance sheet. So all in all, there is a 500 million net cash flow balance or cash on the balance sheet. So that's a strong balance sheet. It's growing on its top line, and it's highly free cash flow generative. So they're able to repurchase shares, not only to offset the dilution on the stock-based compensation, but really bring down the number of shares outstanding. So at the top end, they're going to exit the year with 404 million shares outstanding. So it implies that at the top end, the number of shares outstanding is down 3% since last year. But if you remember, for a business that is predominantly a software business, they have a lot of stock-based compensation. So even accounting for that, they're able to offset the dilution and still bring down the number of shares outstanding. So I think that this is something that these investors should be mindful about. So one thing that I want to say, if you compare, let's say, to other software companies, you're not going to see many that have this high level of user retention priced at 5 times this year's revenues. You're going to see many of these companies priced at 10 times or 12 times this year's revenues, and they're not even making any free cash flow. So in the case of Dropbox, the free cash flow is approximately 28%, is coming into, the non-GAAP operating margins are coming in at somewhere between 28 to 30%. So of the revenues that they're making, close to 28 cents to 30 cents drops as operating profit, non-GAAP, obviously. So you have a business that generates some top line growth, it generates plenty of free cash flow, repurchases shares. So just compare to one of its peers, Box is priced at 4 times this year's revenues. Now keep in mind that in the case of Box, investors are really seeing a fraction of the free cash flow generated from Box than they are seeing from Dropbox. So all in all, you can see that there is a business that is growing, it is making free cash flow, it has this target to make 1 billion in free cash flows by 2024. So if you look out to 2024, which is in 3 years time, the stock is priced at approximately 11 times free cash flow, and they're repurchasing shares as well. So you're really getting a bargain here. I think this is something that's compelling, worthwhile considering. But if you want to know what kind of stocks I'm excited about, don't forget to check out my marketplace. It's called Deep Value Returns. My platform is a place to help you become better investors, really handhold your investment process and to help you out thinking about investing generally. You're welcome to do a totally free trial to see if it suits you, and you can cancel anytime before 14 days and you're not going to get charged anything at all. So with that aside, I really hope to see you next time. Okay guys, bye bye.